We stay away from the radius measurements because what we found is, especially if it's in a brokerage OM,
Hmm.
they'll pick a whatever radius happens to snag a wealthy neighborhood nearby and
Hmm.
bring bring up the average. So, and I don't remember where this statistic comes from, but I've heard it several times that supposedly 80% of your renters will come from within a 2 mile 2 mile distance of your property.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else. With your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. With me, as always, is John Cohen. How's it going, bud?
We got no complaints. We had a little snow flurries this morning.
No way.
Yeah, it was. I saw like 3 or 4 of them, but it's cold. It's 30 degrees. It's getting colder, so it's it's that time of year, so it's should be interesting.
Yeah, it was funny. It's just weird being in Florida. It doesn't really feel real, but it was actually very cold this morning. It was like 35, 40, but now it's up in like the 50s. So it's not the end of the world, but I wasn't sure if I would need sweatshirts or not, but I'm glad I brought them because today's the day for it. I actually went out with a sweatshirt and my big jacket, but then by the time 9 o'clock hit, it was too much. So
there you go.
We'll see. Yeah, it's nice now, but we'll see what happens once August rolls around. I'll probably be singing a different tune and sweating my ass off.
It'll be humid and disgusting.
Yeah, exactly. So not ideal by any means. But it is what it is, right? It's part of the adventure, part of the journey. So we'll see how it goes.
There you go.
But let's jump into today's episode. We got a really great guest on today. I think we're going to have some really good conversations. I'm excited to hear his story, learn from him, and kind of pick his brain about things. So with that being said, Andrew, thank you so much for joining us.
Oh, glad to be here. It's very chilly, 86 today in Southern California.
Hey, you're just living the life, laughing at everybody, right?
Yep.
Awesome. So you want to kick things off, just a little bit about you, your background, journey, experience, etc.
Yeah, like I mentioned, I live in Southern California. Been here about 20 years. Originally came out from Texas. I did the reverse of what everyone does nowadays, and I used to be a chemical engineer. But that was never my long-term intent. That I just got that job and degree as a way to have a good income until I figured out my real calling. Got married. My wife and I tried a bunch of businesses. Just stumbled upon flipping, and that worked for us. So I quit my job, and we did that full time for about 4 years here in Southern California. Started that in 2007, and in 2009 and 10 we had really good years flipping. But we said, hey, this isn't going to last. Everyone else is figuring out the opportunity, so it's getting super competitive. A lot of the equity's gone, and it's kind of playing out a little bit. And she said, well, all right, well, what's the next big thing? I said, okay, well, we just had a big recession, 2008, right? And that means we're going to be starting probably a big recovery. And then all these people getting foreclosed on, they can't buy a house for 7 to 10 years. So that means they're going to rent. So, okay, we're going to have a recovery and a bunch of people transitioning from ownership to renting. So, okay, apartments should do really well. So we went and found a mentor, someone who just kind of word of mouth, who was in the business, who agreed to let us hire him to kind of guide us along. And our first deal, we went and bought a mostly vacant 92-unit apartment complex in Macon, Georgia, on the other side of the country. We syndicated that, meaning we pooled the money together to purchase it and renovate it, because we didn't have. We needed 1.2 million total, and we didn't have it. And since then, I've done about 1,800 units or so across the U.S., Southeast U.S. And that's been our full-time business since 2011. I love doing it, and it's been really good. So, yeah, that's kind of the condensed version.
Mm-hmm. I love it. No, that's good. I think one thing that's interesting, and maybe you just don't touch on it, but obviously you said you started in 2007, but it doesn't really, or didn't sound like you guys got hammered when the recession hit. Is that true, or did you guys get hit pretty hard?
Well, our market did, but we saw that as an opportunity. Now, fortunately, we did not have like a big rental portfolio or something at that time, in which case the values would have dropped. But what we saw is we said, hey, we're entering a big recession. Everybody was scared to death of real estate. We had zero competition for like a year and a half, and prices were dropping like a rock out here. And there were some condo complexes in certain neighborhoods where the prices dropped 70% from peak to trough.
Wow.
So what we would do is we'd look at a property, we would buy it for 50 or 55 cents on the dollar, right? So buy it at, 50% of its worth today, fix it up and plan on selling it at 80%, right? So we led the market down, and we never lost money on a single one ever. And it never took us more than 30 days to get one sold, because we always made sure it was the nicest property and the best priced property. And so even if there's only one buyer in that whole submarket, we got that buyer. And so one thing I like to say is there's no such thing as a bad market, just a bad strategy. So we just adapted a strategy to fit a falling market. Everyone else was just terrified and left. And we had a couple of really good years.
Gotcha. I think that's awesome and a really important lesson. How did you guys avoid getting caught with your pants down, through that period though? Because obviously, it's going up and up and up. Did you guys just not have any ongoing projects kind of as the peak came around and got lucky, or did you guys do something?
Well, we started in 2007, kind of right as we sensed things were topping out and that there was going to be a lot of distress. That's part of why we started then. And when everything locked up, I think it was the fall of 2007, we had, fortunately, at that point, we only owned one house. Of course, here in Southern California, every house is a $500,000 house, even if it was built 100 years ago and falling apart. So we only had one house. That one we had projected to make a $75,000 profit on, and then all of a sudden the REOs started popping up on the corners of the neighborhood and literally dropping prices $50,000 at a time for those to try to get sold. And so that was the one where we could have gotten caught. And I remember people telling us, "Oh, don't worry, just the Fed cut rates, just rent it out, it'll bounce back." And we're like, not so sure about that. So we fire saled that one. We cut it all the way down to just above break even to get rid of it. And then that's the point at which we dramatically changed our strategy. So that was the worst one we ever did. We made $4,300 on, but that was intentional. We saw the rapid shift and said, okay, now we got to change, get rid of this one before it becomes a problem. And then everything after that was great. So.
Gotcha. So
it's funny, right? There's no such thing as a bad market, a bad strategy. That parlays almost directly at where we are today, right? Because that was the bottom, or what soon to be became the bottom, right? How does one go about, in your best opinion, not that any of us have a crystal ball, unless you do, then you should share it, give it to me on our mastermind calls, not on this one. But what do you look at going forward now for anyone, that's thinking, did I miss the boat? Is it, my day late, $1 short? How does one go about buying something today that you feel really confident in, that the strategy is going to work regardless of who knows what happens?
Well, one thing is to place yourself where you're going to have long-term macro tailwinds supporting your strategy, right? So, Chris, you just moved to Jacksonville, right? That's a market where people are moving there, incomes are going up, and that's not going to change if we, based on coronavirus or a recession, short-term recession. That's the growth of Florida in the Southeast U.S. That is now a decades-old long trend that is going to accelerate as we go forward, especially as taxes probably go up, right? That low tax environment is going to become more important. So, we look for markets, and then it could be a state, it could be a city, it could be a submarket. This applies from the macro all the way down to the micro. We look for markets where, okay, people are moving there. And that means there's a housing shortage, right? I mean, nationwide, we have a housing shortage, but you want to go to a place where there's even more of a housing shortage. We look for places where incomes are already strong and increasing, right? Those two things alone really are probably the biggest things you can do to ensure that you're going to be in a market where you've got a tailwind or a rising tide. And then when it comes down to the actual specific property, is we make sure that what we're buying makes sense today, right? So, for example, we're about to go under contract on a property now where there's a significant amount of upside in that it cash flows from day one, which not to say that a property has to cash flow from day one. There's some if you know what you're doing, there's some excellent deep value add strategies, right? But that's just a different business model. So the property cash flows from day one, and the rents at the property are well below market for some management reasons that we can easily solve. And when we look at it and we underwrite it, we say, hey, look, we don't need any market growth for this deal to pencil out. All we have to do is just get it up to the current market, and it's amazing. And all right, well, let's do this. If the market's up here, let's put our target a little bit below the market. Now, how does it look? It still looks great. Okay, this is a deal that we want to buy. It's in a market where the population growth is 3 times the national average. The median income is above the national average. They're not building enough apartments there, and we can buy it so that it makes sense today. It cash flows, it's got upside. We don't need the market to grow. And if any of those other things happen, the market grows, people keep moving there, then it ends up even better, right? So that's our strategy for right now in somewhat of an uncertain market. And yes, the next 3 to 6 months might get kind of rough with shutdowns and coronavirus and all that. But odds are 12, 24 months down the road, that's going to be in the rearview mirror. And especially if you're looking 5 or 10 year timeframes, by the time you get 10 years down the road, this is going to be long forgotten, I hope, right? and the value of that real, I mean, who do you know that have ever that bought real estate 10 years ago and they're sitting there, I wish I hadn't bought that and held on to it, right? You almost don't come across no one who regrets holding real estate long term. So that's our strategy. And then also we do try to lock in long-term fixed debt so that we don't have interest rate risk. And, you can, if rates go way up, we can sell on an assumption, which is a value add. If rates stay down, great, we can refinance later. And, so it gives us options. So that's kind of, that's the approach right now.
No, I think it makes a ton of sense, right? That's sort of how you have to go about it. Cause I'm as negative can be, right? When it comes to the future outlook on anything, especially given the last 12 months have just been, a complete tailspin. But I do think one distinguishing factor that hasn't even been addressed is that because of what just happened and the ability to work remotely and virtually and not having to be in an urban city that you may have once been, like, Southern California or New York, now people realize that where multifamily has always been, good job growth is always going to be important. But now the amount of influx of population into states like Florida and the tax advantage states and, other areas in nicer, warmer weather, I think that that's going to be another catalyst where population growth is still going to flee from the north, from the West Coast into these areas. And as if you follow that trend, you can protect yourself. And that's going to be good submarket, good product. And what we do, which I loved, is I never want to be the market leader. If I can be a little bit below but rival that, well, I know I'm okay. Worst case scenario, right? I know I have some room. So I think that that's a very important thing. And I think that's something that will help push this market, whether it goes another 2, 3, 4, 5, 10 years, that population growth is going to be huge and people are going to need a place to live. And if it gets really bad, the housing market's crazy. So if it goes up, people won't be able to afford it. If it goes down, well, people are going to need to rent. So I think you win on both sides of the coin there. Yeah,
I'm always trying to wrap my head around that. Like, wait, it seems like we win either way. Is that really true? But it appears to be the case. So
it's crazy because I was at an open house yesterday. Because I like to just I really like to basically look at these agents and call them crazy. And there's a house that's selling in the school district I went to high school in, and I went to the house and I'm talking to her. And I said, listen, this one's going to struggle. And it is. They're never going to get the price they want. But I looked at it, I said, this is not an affordable house for anybody. It's, it's not in, it's in a higher end market that, taxes are $18,000 a year. I said, this is not like someone could just, pick up and buy it and it needed $300,000 worth of renovations. So it's not like this is not down the fairway for anybody. And she called yesterday and she's like, it's not going to sell for a penny less than $800,000. And I'm like, okay, I hope to God you're right. For your sake, not for anyone else's sake, but at the same time, because that's so unaffordable for the average bear and so many people are leaving New York, what happens to that house? And then simultaneously, they're all going to areas where, maybe they don't want the headache of that stuff. So you're right. That win-win situation does exist as long as you're in the right location. If you're in the wrong location, I think you could feel some pain in the next, 2 2, 4, 5 years, whatever it looks like. But if you target the right locations, it is almost a win-win situation. Granted, if you know what you're doing.
Yeah. Key point.
Yeah. Well, I think it's interesting. I was just with a contractor at the property, and we're just talking about, rents and, looking at the cost of home ownership. And I do worry sometimes that because there's been such a trend of people wanting to rent in the last 3-5 years, John, you've talked about it a lot of, as COVID hit, so many people moved away from New York City or these small apartments because they wanted the space. And how are people going to view that going forward of buying a home? Because, around where I'm buying, houses sell anywhere from, 100 to 250 kind of on the high end. You buy a $150,000 home, 5% down, you're talking, what's that, 30,000? Is that right? No, that's 20%, right? I can't do mental math. 10%.
How much on $100,000? 5% is $5,000.
7,500, right?
Yeah.
I can't do
on 200,000 it's 10 grand. On 250 it's 15,000. Whatever.
Right.
Give or take.
So it's not a ton of money, and then your mortgage is going to be $1,500 a month or something like that. So I just wonder how this period is going to affect people's decision making in terms of housing going forward.
Well, I mean, it certainly seems, and I will say, just like it seems like the last few years before the pandemic, everyone was calling it the death of the suburbs, right? Everyone's moving to the city and the suburbs are left for dead, right? Now all of a sudden, the cities are dead. Everyone's moving to the suburbs, and it's like the cities aren't. New York's not dead. Right. It might be on life support for a couple of years, but it's not dead. But I do agree though that it's. I think will lead to both a short-term and a long-term shift to the suburbs, like what John was saying earlier. People don't need to, when they realize they don't have to commute an hour, hours a week sitting in the car. That's very favorable for the suburbs. And I can't pretend that we saw a pandemic coming and planned this, but all of our properties are garden-style suburban properties in the suburbs. And what garden style is it's not the high rise where you got 8 stories and small units. It's 1,200, 1,300 square foot units that have patios and decks and lots of green space in between the buildings. And I think that type of property is going to benefit, right? Because so for the person who can't go out and buy a house, or maybe doesn't want to, okay, well, hey, I can go live in this 2-story apartment complex, get 1,300 square feet, and it's got playgrounds and a pool and some outdoor space. I can go, I can lock my dog in the dog park and go read. It still caters to those desires and needs that are, kind of being accentuated by the pandemic. And once this is fixed and everyone feels safe in large groups again, I really do think that the cities will bounce back. There is going to be a long-term effect of not as many people feel like they need to go into the city to work. But there's certain groups of the population just love the amenities that a city provides. And so that to me is actually possibly a contrarian opportunity, is either now or in the near future to go into the urban cores. And if you can get really good deals on properties and hold them for 10 years, which again, in that time frame, this is probably going to be long forgotten. That could be a really big opportunity. Not my strategy, but something that again, being contrarian, when we started, everyone said, "Oh, geez, get out of real estate." And we're like, "Well, we're diving in. It worked out great." I could almost see that, long term, going into select cities and select markets, and that could be an opportunity. But again, kind of what John was saying, I think that the long term, the trends are going to shift. This has accelerated the technological move towards remote working, where people can live anywhere they want, and if they can live in a place with space, low tax environment, warm weather, a lot of people are going to go do that.
Mm-hmm.
And then to that point, Chris, also I think the other side of the coin, the cost of home ownership on a physical dollar for dollar may make sense. And if it is 5% down, more people will be able to afford it. But at the end of the day, people move into houses are typically most likely families with kids that are going to have to go to school. And the better school districts and the better submarkets, the houses may be more expensive, where that a cost of an apartment, a 2 or 3 bedroom apartment in that garden style complex, probably is a little bit cheaper. Also, I don't want to say safer, but you may feel more comfortable around people if you are a working parent and your kid comes home from school or something like that. So I think that's that buffer where you're going to be able to, there always will be a tenant for that seat, right? Think about Orange Park in particular. The cost of living is a little bit more expensive. The school districts are great. We both own properties there now. And I think that those seats will always be filled because of that component, right? There's a really good school district and the houses may be a little bit more expensive, and not everybody, although 15,000 doesn't sound like a lot, it is still a good chunk of change. Also with, unemployment where it is, a lot of people might not have jobs for the next whatever amount of time. They can't just walk into a bank to go get a mortgage because their income may not be there right now. So maybe the lending world doesn't look good for them. Additionally, mortgage volumes at like historic records. So now banks are picking and choosing their borrowers. So they look at an application comes in and says, well, this guy works better, right? And there's all different mortgage lending laws that they have to follow. But at the end of the day, they can pick and choose the best of the best that they want to refinance or finance. So that can prevent, the average Joe or Jane to get into that, maybe that starter level house, which should keep apartments relatively full, pending pandemic evictions and all that good stuff. But that's where I think you could put some confidence in as an apartment buyer that you still should have really good occupancies. Maybe they're not going to be 96, 97 like they were for the last couple of years. Maybe they're back to the norms of 92, 94, but it should stay pretty healthy in my opinion.
No, I think
I agree.
Yeah, I think it's a good point. I think it's just something that, depending upon the submarket, you have to look at is it, the transition for, like a lot of that B-class stuff is, it's the transition for the person that's buying the home versus if you're in that C-class space, which is a lot of our stuff, it's, the renter by necessity. And then, when they move out, it's, for a number of reasons. Not as often though, is it home ownership. Usually it's just, something else. So I just thought it was interesting as kind of going into that space. And as I'm considering different renovation levels for what to do, it's something I've been thinking about a lot of, how nice do you make it and how much do you push rents and how does that compare with, someone that is looking to rent or maybe it's home ownership. It's, it's just one of the things I've been trying to learn more about of like, how do people view it with, the median income in the area? How do they look at it versus the housing cost? Because like we always did at Toro, like you said, we always tried to be the step below, the other stuff in the market that's very similar, or half a step below, because you have a lot of confidence in it. But for me right now, I'm kind of sitting on something. I'm like, hey, maybe this is an opportunity to try something a little bit different, or, try a slightly different business plan. That's, I'm not trying to take an 800 average rent to 2,000 because that would be ridiculous. But instead of going from an 800 to 1,000, can you do something where you get it to, 1,050, 1,100, maybe upwards of 1,150? And what does that look like? And it's something that I've been trying to learn more about and find out because I think it's interesting, a little bit, probably some additional risk. But obviously the more you can increase the rent, the more valuable it becomes. And, our plan is to refi and hold. So it just allows you to pull more capital out and, or, have a way better coverage ratio in the future that you can feel way more secure about for the next 10 years. So that's why I was kind of asking. I'm just curious, how other people are viewing it. And do you guys ever look at, as you're looking at properties, do you guys look at like the housing costs and the median income and what people can support as you kind of look at the future rents? Or do you kind of do what we've always done where you just look at what other properties are doing and you try to butt up against that or underneath it?
The median income is, so we have a screening procedure where we go, before we even look at a property, we have, I think it's 7 things that we check. And one of the most important, one of them being population growth. We already talked about that. And candidly for us, one of the most non-negotiable ones is that median income. And what we look at is we say, okay, if we're going to, whatever rents are today, our target rents, so let's just say they're 1,000, maybe it's 800 a day, but we want to get it to 1,000, right? So if we take rents to 1,000, we want that property to be located in an area where the annual rent burden to someone leasing our apartment they only have to spend ideally 25% of their gross income to rent that apartment, and at the minimum, no more than 35%, right? Because the definition of rent burdened by, I think it's HUD, I think it's if you have to spend more than 35% of your gross income on housing, then you're considered rent burdened. So like in California, it's a crazy 50-60%, right? No one can you have to make make well into the six figures out here just for your housing to be affordable. It's crazy. So what we look at is we say, okay, if let's just say if you take all 12 months at an apartment complex, it costs $10,000 a year to rent a unit, right? So what we're going to say is, all right, well, that means ideally we want that apartment complex to be in an area where the median income is $40,000 and above, because that means the median person or the median family there only has to spend 25% of their income to rent our apartment, which means it's going to be affordable, which means we're going to have plenty of people to pull from, to lease to, and our residents aren't going to stop paying rent because they got a flat tire, right? They have some room in their budget to cover life expenses, have a little bit of disposable income. And when we started doing this about 5 or 6 years ago, because we looked back at the properties we had acquired and said, all right, which ones have performed the best? Which ones have had the least headache? Just kind of, and just pulled them all apart. And we said, there's a very strong correlation between how well the property did and how high the returns are. That correlates strongly with with how affordable the units are compared to the median income in the area. So that's number one. And then also, Chris, getting to what you said, the second thing is we look at what everyone else is doing. And we're very much kind of like what John was saying, and I mentioned this earlier with the property we're looking at now. We shoot to be just a little below everybody else, and have an equal or better product, but be priced just slightly below. So if there's that person who's looking at the three competitors and us, they're like, well, I can save $30 a month, and this place is just as good. I'm going to go over here and lease from Andrew, right? So median income is one of our most important qualifications, which is driven by affordability. And then, we're looking at what everyone else is doing and trying to undercut that just a little bit.
Is there a certain range or area that you look at? Because I know oftentimes you see like the 1, 3, and 5 mile radius. Is there a certain distance away you look at when you look at that median income?
Yeah, we stay away from the radius measurements because what we found is, especially if it's in a brokerage OM, they'll pick a whatever radius happens to snag a wealthy neighborhood nearby and bring up the average. So, and I don't remember where this statistic comes from, but I've heard it several times that supposedly 80% of your renters will come from within a 2 mile distance of your property. I don't know if that's true or not, but it does seem like it. People are just kind of moving from one neighborhood to the other or whatever. But so what we do is we actually look at the median income at the tract level. And we say, we don't really care about a radius because that's kind of just an arbitrary ring, and it can include all kinds of things that don't apply. Think especially in certain areas of the country, take Houston's a great example, or LA. You don't 2 miles away can be a whole nother world, sure. Right? Especially in Houston and Los Angeles, you cross the street and you're in a whole nother world. So it doesn't make sense to say, well, I'm just going to average everything, in a 4 mile wide circle. So what we do is we look at the actual neighborhood, and there's 2 data sources we use for that. One is we actually pay for ESRI, ESRI. And they break the median income down to like tract and county, and you can look at it a lot of different ways. And then there's another site called richblockspoorblocks.com. And I think if someone wants to check it out, I think they let you do like 10 reports for free, and then you have to pay for it after that. But we use that to actually look at it down to, okay, what neighborhood is this property in, and what's the median income in that neighborhood, and then what are the median incomes in the adjacent neighborhoods, and then if we're getting deep into a property and looking into it, we may we'll try to figure out, okay, well, what's the trend, right? Is it if there's a low income area over here, is that low income spreading, or is it the other way around? Is it gentrifying and our income's going up, right? And that's done by, trying to look at either historical data or just talking to people who've been in the market for a long time.
Mm-hmm. Yeah, I know. And I don't know if you've ever looked at this and decided not to use it. But if you go to city-data,
yes, we use that.
Is that how you look at the trend?
That's one way, and we use city data for a handful of other data points. But like I said, the incomes trend, we get that from Esri now.
Mm-hmm. Gotcha. Yeah, I know. I found there's one free resource. It's through some Jacksonville company that they actually produce those reports for free, I'm pretty sure, which is pretty cool. But I didn't see any of the track stuff. They only did like the 1, 3, and 5 mile radius. And I think it's a really good point you bring up, right? Because if you're in, Brooklyn or downtown Detroit, any of these cities, right, the blocks are so close together. Anybody knows you go somewhere, one block can be very different. But do you guys then focus more, because a lot of your stuff is suburban garden style? Do you still look at the tract more, or do you still go for maybe, those different radiuses and look at it? Or do you look at a blend between all the different options and just try to gauge? Because it is still block by block when you're in that suburban area, but your blocks are a little bit more spread out. And also, sometimes your comps for properties, there's nothing within, a few miles, a couple miles, or even sometimes, 6, 7, 8, 9 miles.
Yeah, you're right. There's usually not quite as a distinct and dramatic change from one street to another when you get out to more rural areas or suburbs or smaller cities. But we still just focus on the tract. And when I say tract, I don't necessarily mean like, okay, they built, 100 homes in this neighborhood and that's a tract. It could be, sometimes, especially again, as you move out and get less dense population areas, that might be a 1 mile by half mile long, stretch or something like that. And it varies. Sometimes it's an entire zip code, so it varies. But yeah, no, we don't look at the radius at all. We really want to know, what is this neighborhood or submarket like? And sometimes I find even in rural areas, it's cliche, but you say the other side of the tracks. I can't tell you how many times I've seen railroad tracks divide high income from low income and school district and all of that stuff. So yeah, we still look at it that way.
Yeah, no, it's very much the case. I mean, I was checking out a deal that, John was looking at, and it's very much, a couple blocks, and I don't want to say the wrong direction, but maybe not necessarily in the right direction. And it definitely plays a part into, some of the comps you can go for, and definitely the median income and stuff like that. So you're right. I think there's always that barrier, but I think, when you're in those urban areas, those, if you want to call them tracks, they're so much smaller and so much more micro, where I think as you get into the suburban and then definitely in the rural, there's definitely that point where it changes, but I think those tracks are probably just far larger, which is why I was curious if you guys do the radius stuff. But is there anything else you guys look at? You mentioned, several different things. Is there anything else as you were doing those, looking back at those successful deals that you found was a pretty good correlator between your most successful and, I don't know if I'll say least successful, but your other ones, we'll say?
Yeah, crime. Mm-hmm. Yeah, we definitely stay away from high crime areas. And now notice I did not necessarily say we stay away from higher crime properties, because sometimes you'll come across a situation where the property you're buying, that's the problem, right? The property you're buying is the one dragging the neighborhood down. Well, you can fix that. You can control your property. You can clean up your property. One in Fort Worth, Texas, I can think of, where the entire neighborhood was on the rougher side. And yes, we cleaned up our property, but then stuff would happen in the neighborhood. And I remember there's one time they literally climbed over our fence. A brawl started. They climbed over our fence, came into our property, and we ended up with 4 stabbings and 2 homicides that night, right? And it's like, we've got security cameras, we fenced it, it's gated, they climbed over, and it's like, okay, you can't clean up the neighborhood. And then also, so number one, it gets to a point of, you can that stuff like that, severe, no matter how well you fix up your property, stuff like that will limit the quality of people who are willing to live there. when that kind of stuff goes on, even if it's just outside the boundaries, right? The other issue with high crime is it makes it much more difficult to get a loan. Fannie and Freddie, one of the things which are your agency lenders, they look at crime. And if you've got a property in a high crime area, that's going to increase the chances of getting rejected for that loan, or they're going to give you less favorable terms. And so what we looked at is, okay, not only are the higher crime properties more headache, but the returns weren't as good. They tend to not appreciate as well. When you do get into a recession or a weak economic environment, those properties in those neighborhoods, they fall first, they fall the fastest, and they fall the farthest. Whereas, your B class properties or your even your C plus that are just in good working class neighborhoods, those tend to be a lot more stable. So crime is something that's also a no-go for us.
Mm-hmm. Yeah, you bring up a good point, because I was listening to, I think it's the Commercial Real Estate Show. It's a podcast that's been going on for like 10 years. And they had on, it was either like someone from Yardi or one of those companies, and they were talking about collections in the multifamily space. And it was like, A and B was like 95% plus, but your C was down in like the 90% range, in and around, like 88 to 90, 92 or whatever, which, right, wasn't terrible, wasn't as bad as we all feared, but that is a noticeable drop off from your B and A stuff. And, obviously people can, like you said, you can get more segmented and stuff like that, but just from a high level, they were kind of talking. And that was on average across the nation, right? Markets are going to change how that was. But just from a big picture standpoint, it was really interesting to hear that. And I think, we've definitely seen that in even our own stuff, our nicer quality stuff to a certain degree has performed significantly better or been less of a headache over the past 9-10 months, especially early on, than, some of our worser stuff.
That makes sense.
Yeah. So what are you guys looking for in today's environment? Like, are you guys changing your thesis at all? Are you guys sticking with a lot of the same stuff, or are you kind of, waiting things out? Are you guys being super aggressive? Like, what's the current mindset?
Yeah, we're fortunate in that, our target markets and properties were already, secondary, tertiary cities, suburbs. We're in suburbs of, like, for example, Atlanta, that are, 30 to 45 minutes from downtown. Mm-hmm. And those are the areas that are really benefiting from what's going on right now. So we're continuing that. We're, on acquisitions, we are being less aggressive with rent growth assumptions. I've seen a lot of forecasts that are predicting rent growth by the end of 2021. Okay, maybe. I think it depends on what market you're in. We're not ready to factor that in just yet. I could see the case for that possibly happening, but we're not willing to underwrite to that, right? So we're assuming zero market rent growth for usually 2 years. And now I said that's market rent growth. We may be doing a value add or, an improvement to the property, and we can force, rent increases up to market. But as far as overall growth, we've dialed that back. And we're definitely trying to we're trying to look at it, long term, of, all right, we want to set it up so we have multiple exit strategies. Like, can we get out of this in 2 or 3 years? If the market, makes it, that's the most profitable. Can we hold it 10 years if the market dictates that that's the most profitable way to do it? So we're trying to really make it so that we have flexible exit options, because I've listened to so many people way smarter than me, and half of them have a great argument for why we're about to go into the most inflationary period we've seen in decades. And then on the other hand, I hear people who are just as intelligent have a fantastic argument as to why we're going to be in a deflationary period for the next 5 or 10 years. Mm-hmm. And I hear these fantastic, I hear the argument like, wow, that's solid. And then I hear the opposing argument like, okay, wow, that's just as solid. The reality is I have no clue what's going to happen.
Right.
So I go back to buying properties that make sense today. And I say, hey, that where it's a rising tide, that, going back to the population growth, the income growth, and that, what we look at when we underwrite is like, for the things that we can't control, let's be in properties and markets where the things that we can't control are as much in our favor as possible. and then worry about the things we can control after that. And that stacks the odds in our favor. And that's what we try to do, right? So we look at stuff where there's some value add to it, which could be management, it could be physical renovation, all those very expense reductions, better systems, all that kind of stuff. And then markets that we expect are going to continue to grow and be favorable business environments and all those kind of things. And we believe that stacks the odds in our favor. And then it's every single person who ever goes, a multifamily person who ever goes on a podcast now, if I hear the word conservative again, I think I'm going to vomit, right? I mean, what does that even mean? Exactly. It's like, well, I'm assuming 7% rent growth instead of 8 now. It's like, to me, it should be realistic, right? The reality is none of us really have any clue where things are going. And so, okay, well, where are we today? What is most likely to happen, and underwrite to that? And to me right now is, okay, let's assume no rent growth for a couple of years and probably higher delinquency, maybe higher evictions for the next 12 months or 24 months or whatever. But if you set yourself up right, I think once we get past this, multifamily is definitely one of the strongest places to be.
Mm-hmm. Yeah, no, it's funny. I mean, I was talking to somebody and we're running through a deal and they're like, oh, but they underwrote super conservative. They said so. I was like, who in the right mind is going to come out and say they didn't underwrite conservative? Like,
yeah, exactly.
You know what I mean?
Like, just for once, I want someone to be like, you know what, John, I got to tell you the truth. We really went aggressive on this. And, it's just like, no one says that ever.
It's actually funny. So Chris toured a deal for us the other day. And this morning I got the call. He's like, I think you were right. And when I looked at the deal, I literally said something. I said, I'm going to be as aggressive as I possibly can in this situation, right? Like, I even was selling it at a sub-6 cap, which I would never do. I went to the complete form of aggression that you would never see in underwriting. And I was like, this shit doesn't fucking work. The deal's just not going to work. So
yeah,
I basically said, this one's never going to work. And today he called. He's like, yeah, you're right. This deal's not going to work. I was like, yeah, I told you that 3 weeks ago. But yeah, it would be funny to see that person come out and say, well, I'm pushing the needle on this one. We have 10% rent growth, 98% occupancy, and there's nothing on the horizon that's going to be bad. But everybody is conservative and all that crap. So it is what it is.
Yeah, no, I hear you. I think it's interesting too to hear everybody talk about the different future, because for me, when I hear people talk about it, there's so many assumptions that they're making when they're talking about the future that you have no idea if they're true. I mean, not even just in the States, but I mean, there's so many other things that come into play, global economy, when you're talking about different currency valuations and oil and moving to, I mean, there's a million different things that's not even worth going into, but you have no idea what all their assumptions are. You talk about investors looking at conservative underwriting on a deal, and think about how many ways you can change a deal to be conservative, not conservative, make it look good on paper. And now you want to talk about, a very similar thing in world economics. I mean, think about how many different things can go on, or how many different levers people can pull to make their argument. I mean, I probably only know of a couple percent of the possible assumptions people make or are making. So it's so tough to even, predict what it's going to be. It's like, how do you even know who to listen to? And I think one thing that everybody kind of falls back on is that, you just look at the history of real estate over and over again. It just seems to be a pretty good place to park your money. And like you said, it's very rare you find things that people bought at the peak that, if they didn't hold 10 years, that they didn't at least make their money back or do okay. I mean, I have seen here and there. I remember one condo conversion deal we looked at in Jacksonville where people bought condos for like $300,000. And, as of a couple years ago, they were selling for like 120. So, they kind of, were the unlucky few in the country, but, you're right. Over decades, real estate tends to do well. So it's the type of thing where you can kind of fall back on that a little bit.
Yeah. Well, I mean, if you look at, okay, let's say 20 years ago, you bought a house in Detroit for $100,000, you put a $70,000 mortgage on it. Right. And you put $30,000 down, and now let's say you did a 15-year mortgage. So 15 years later, you put a renter in there, it broke even. 15 years later, that $70,000 mortgage is paid off. The house is worth $50,000, right? You on the surface, you lost $50,000. No, you didn't. You have $50,000 in equity. You started with 30. You still made a 66% return. Is that a great return? No. Is that what we're trying to do? No. But if you buy real estate, and that's one of the amazing things. If you buy a stock and it goes bankrupt, you're out. You've lost 100%. You buy a crappy house or real estate investment. In most cases, if you hold it long enough, because of inflation and principal pay down, all those things it's very tough to actually lose in the long term, right? And so that Detroit example, would we want to make that investment? Well, absolutely not. But it's just goes to the example of, if you hold long enough and do other things right, it's in most cases with a given enough time, you can still make a positive return.
Mm-hmm.
Real estate, typically time heals all wounds for the most part.
Yeah, for the most part.
If you can hold it. If you can withstand the beating you take in that drop, but you typically can come out okay.
No, 100%. But I think that's a great place to wrap up. Andrew, thank you so much for coming on and sharing your insights and experiences. If people want to learn more about you, follow you, get in touch with you, where can they do all that stuff?
Yeah, I'm on all the usual social media channels and whatnot. But really, probably the best way to, if you actually want to connect or start a conversation, is just our website, vpacq.com, short for Vantage Point Acquisitions. There's a couple of different links on there. One to just reach out and connect, and there's another for our mastermind where we for people who've actually done a deal already and they're just looking to grow and scale. And but that's probably the best way, is connect on there, send us an email. It comes to my inbox, and we'll go from there.
Awesome. Love it, guys. Definitely go check it out. He's got a ton of great information, and definitely check out the mastermind as well, because I'm sure there's a ton of great people in there. But thank you guys so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that you think would get a tremendous amount of value from this episode. Andrew, once again, thank you so much for coming on. This is great.